Welcome back. Welcome back to another video. In today's video, as you can see, first of all, I'm in a brand new place, guys. It's a vacation day, so I'm not on my usual place anymore. Anyways, today is gonna be my seventh video, or maybe sixth video of accounting. Me doing accounting problems from the accounting book. It's the Beams Advanced Accounting book, and I've taken two questions from chapter 7. Today we're going to be talking about them. So I guess let's just get into it. First question is about journal entries. So a parent company owns 80% interest in like subsidiary company. I'm just going to say it using like parent and subsidiary instead of the actual name because to me it's like much simpler to talk about it that way. Now the subsidiary issued bonds, right? And it has unamortized discount. We'll talk about that later. The parent purchased 50% of the outstanding bonds for this amount. It has a pay interest bonds. The bonds pay interest on April and October, and it's amortized using straight line method. We need to prepare journal entries. So these are the informations that I've taken from the case. We have the ownerships, the bonds that were issued, the unamortized discount, and the bonds that was like bought by the parent, because the parent bought the bonds from the subsidiary, so it's like downstream in a way, right? Uh, so what I first did here is I determined the book value. Why do I need to determine the book value? Because that will allow me to calculate the gain or loss, or as we call it, constructive gain or losses. And to do that, we basically want to deduct how much we bought the bonds with the book value. Okay, and to get the book value, what I did here is I deduct this, the bonds issued with the unamortized discount. So I deducted by that, and then I multiplied it by 0.5 since the parent only bought 50%, and that should be the comparison to the amount that they actually paid. And we can see that what we get versus what we pay, that what we get is less than what we paid. So anyway, we're paying a little bit more than what we get, and so there's like a loss in there. So this is the loss, and this will affect the journal entries as well, because if we go here, when we first purchase the bonds, we want to record this. So we record investment in the bonds as well as cash since we're expending money. And then we also want to record this. This is a journal entry that we record to recognize the bond issuance in a way. Okay, I think this should be like before this or something. Maybe I'll edit that later. So basically, the company issue this bond, meaning that they have a payable of this amount because they're issuing bonds. But they have the unamortized discount, which will be discount on bonds payable, and then so the cash that they will get is actually 80. So that's the thing about it. Next journal will be the elimination and the recognizing journal, in which we eliminate 50 of bonds payable. And reason we only eliminate 50 and not 100 because the parent only purchased 50%. So in consolidation, they want to like show the amount that they purchase, not the whole thing, right? So they eliminate this 50. And then in return, they also eliminate the investment in bonds. So eliminate this. And as you can see, this is not balanced. Why? Because there is like an unamortized discount, right? We're going to use that. And so we first eliminate the loss. So this loss, right? I mean, we recognize the loss. And we also recognize the discounts on the bonds payable. And I got it through multiplying like the unamortized discount by 0.5 since the bonds that we bought is also the parents bought is also like 50%. And the last thing is the interest income and expenses, which came from the bonds, and we should just recognize them like this. Yeah, so that's basically the journal entries for number one. Basically, to sum it up, we want to record the issuance of the bonds, the purchase of the bonds, and as well as the lost gains or losses if there's any, as well as unamortized discounts or any form of discount. Then we would also want to, I guess, get rid of the investments in Minang's bond, like the subsidiaries bonds, because I like to think of this as like a temporary account, because this will be returned in this like the bonds payable and stuff. I mean like this is like a contra account to the payable, right? And so it's things like that. Moving on to the second question. This is a little bit more work as I have actually worked on it on the bottom here. So basically, there's like a couple of information here. The parent own 80% of in the subsidiary. They issue bonds. Oh wait, sorry, I'm reading the wrong the wrong questions. Sorry. And so, my bad. So 7-3, we have trial balances for two companies, Thanos and Mary, which Mary is like 90% owned by Thanos. So it's like they're like the controlling shareholders. You know what I mean? And so you have additional informations here. There are a couple of them, and basically we want to prepare consolidation work papers. Just to give you guys a real quick definition, what consolidation work paper really means is basically uh, you have trial balance, you want to combine them and consolidate them, right? And so when you consolidate, you have to, one of the steps in consolidation is that you want to make adjustments. And these adjustments that you make are usually towards eliminating incomes or maybe unrecognizing previously recognized profits or something like that, or maybe it has something to do with bonds since it's like the theme for today, right? It's about bonds, so there'll be like some discussions about bonds as well. So basically these are additional information that can be used, and I'm basically, this is the worksheet, the work paper. I actually haven't given it like a proper title, so I'm just going to give it now. So we're just going to say work paper Thanos as a work paper for the year ended 31 December 2014. Sweet. Make it centered, make it like this, make it bold, make it big, like that. Nice. So this is the work paper for them. You have accounts from Thanos and Mary, which is basically the same as this. And in consolidation, usually you would just combine Thanos and Mary's, right? So if you have this amount of sales and this amount of sales, you would combine it and that would be consolidated, right? But then the thing with consolidation as well is that there are certain adjustments that we have to make. For example, to remove intercompany sales, maybe the income from subsidiary account, maybe to record unrealized gains or unsold inventory, unrealized profits, things like that. So as you can see here, from the first thing, we see that they have sales, right? But then we adjust the sales by 800. I did this because I want to remove any intercompany sales. Okay, so the way I got 800 was through this additional information. So, and this applies to all the other journal entries as well, in which it says that the merchandise sales was like 800. So, from Thanos to Mary, so that's like intercompany sales. So I need to remove that. And so that's the consolidated amount. You also have income from Mary, in which I basically eliminate because that's like income from subsidiary. You don't want to recognize that in consolidation because this amount should already go in the uh like the parent's account. You know what I mean? That applies the same to my bad. I mean, I was about to say that as for gain from the sale of land, I also eliminate this. Yeah, that was what I was about to say. And the reason here is a bit different. It's mainly because you don't want to recognize profit from land unless if the land is already sold again. So that's why I deleted, basically deleted the gain that was previously there, and that applies the same to equipment. But then the difference in equipment is that it actually can like depreciates back. So if I deleted 100 here, the 100 will like go back per, as time goes by. Usually like per year, so it will like go back. But what I'm doing here is like basically the same thing, eliminating those two accounts. And I also adjust the interest income as it's part of the internal transaction as well. And there's also gain on retirement bonds that I adjust, in which basically you have like 1 million, right? 1 million of like the bonds, and I divide it by two in this case, and then after that I just reduce it by like this 440, right? And so this is kind of the idea of it, and then that's how like 60 was like here, you know. And then you have, aside from that, you have like cost of sales. Because I adjust the sales, I need to adjust cost of sales as well as this, as well as uh, yeah, basically it, and the NCI share, because I want to also recognize, you know, which part of the share is actually part of NCI and not us as the parent company. And in the end, if I sum it up, that should equal to the controlling share of net income, the net income from Thanos, like the parent. So, you know, it looks really good, right? That's good. Now the next is I also have made like calculations for the RE statement or retained earnings statement, which I made adjustments for on deleting the Mary's income, because the retained earning from Mary's, because this is like a subsidiary. That's why you do consolidation. I also deleted the this account, this account. Wait, hold on. Also eliminated. Oh, wait, my bad. Okay, so the controlling share, I took it from here. Okay, that's why. Okay, it's basically the same number, right? And I used that to actually make the adjustments on these. Dividends, I credit by 100, as it's like we need to report the dividends that are paid to external stakeholders, shareholders. And so in the end, if we just calculate them, we should get the total amount of this, and that will be the retained earning by the end of the year. And the last bit is the balance sheet. So there are some adjustments in the balance sheet as well. Maybe I can say about the, you know, I eliminate interest receivables, and I also uh, manage to eliminate the unrealized profit on ending inventory. You know, they have an ending inventory, but then you don't want to realize any profit from that because it hasn't been sold yet. Unless if it has been sold, then you get to realize it. And it's the same for land, but then the mechanism is a bit different, as this is not inventory. So we sell land, we get a gain or something, and but we don't want to recognize that until we sold the land. So that's why it's unrealized gain. Same goes for equipment, but keep in mind equipment can depreciate, and the amount that we initially eliminate can kind of go back over time. So need to keep that in mind. So maybe that will be useful for like the next year's adjustments, right? I also eliminate investments, bonds that Mary bought from Thanos, so this one. And I also eliminate this investment in Mary account, as basically the investment in Mary account, quote unquote, is already part of the net assets of Thanos. So, you know, you don't really need to do that because there'll be like double counting. I also eliminate, I record like a goodwill here, as that is like the, what it means is basically like the excess paid over the net assets in acquisition. Maybe I need to edit this text like so, right? And the last part here is interest payable, which I eliminate, uh, basically like eliminate interest payable as well. Again, it's like part of the consolidation technique. When you have bonds and, you know, investments like that, you also want to eliminate transactions such as that, especially if it involves the between the parent and the subsidiary. And then I also like eliminate, adjust a little bit of the bonds payable because of how the bond works, because, you know, of like the payment time and stuff. And so if it has been paid, then the payable should be reduced, right? In this case by half. And I also want to adjust the retained earnings, since I only want to report Thanos's common stock in consolidation. And lastly is about the NCI, which what this number means, like 460, is basically the 10% of the Mary's like adjusted net assets. It's basically the portion owned by people outside of Thanos, external shareholders. So that's why we need to recognize that as well. And overall, we can calculate both liabilities and net assets, and that should equal to this. And so this is kind of the worksheet, the work paper that you need to make. And so the main idea here is that you are consolidating these two accounts, but then in consolidation, if you want to consolidate the two accounts, there are certain steps that you need to do. One of them is making adjustments and eliminations on intercompany sales, on unrealized profit, things like that, maybe dividends, maybe reciprocal accounts, maybe the non-controlling share, and any other things, like amortization or something. And so there are those adjustments that need to be made, and so you basically debit or credit them. This like it really depends on what you want to do and the nature of each account. And then basically after that you would have the consolidated amount after adjustments as well. And so basically these are not just combined income from Tannis and Mary, but then there was also like certain adjustments that need to be made, and that applies the same for all accounts. And so yeah, it's gonna be quite short for this video. That's basically how I like to work on these two accounting questions. The first one I did like a couple of journal entries like this. For the second one is like a whole work paper, worksheet, or how I would call it. And so yeah, that's my way. Let me know if I did anything wrong, or maybe I did everything correctly, but then my methods like were wrong, and things like that. Maybe you can let me know in the comments, or you can let me know in person. And yeah, I guess I'll be seeing you in the next video. Goodbye. Goodbye, bye bye.